Good afternoon, everyone. Thank you for joining us for today's Lunch and Learn. I'm Lauren Smith with the International Franchise Association, and we have a great 30 minutes lined up for you. Before we begin, I would like to remind everyone that today's session is being recorded and will make it available later this evening on community.franchise.org. If you have any questions for today's speakers, please add them to the chat box and they will be addressed toward the end. Today's topic is royalty transaction, a unique liquidity and monetization strategy for franchise founders, and it is brought to us by Diversified Royalty Corp. Here to provide today's discussion is Sean Morrison, President and CEO of Diversified Royalty Corp, and Greg Gutmanis, CFO and VP of Acquisitions at Diversified Royalty Corp. Thank you all for joining us today, and thank you to Diversified Royalty Corp, excuse me, for sponsoring today's Lunch and Learn. I'll go ahead and turn things over to you.
Thanks, Lauren, for the nice introduction, and just want to start by thanking everybody for taking the time to hear what we're doing here at Diversified Royalty Corp. We think we are bringing something very new and unique to the whole franchise community, and we think the IFA is the perfect platform for us to let the world know, and primarily the owners of franchisors know about this unique royalty transaction model that creates a unique liquidity and monetization strategy for franchise founders. So that is the headline for the presentation, and look forward to getting into it and walking you through it. At the end, please, as Lauren's mentioned, if there's any questions, we'd be happy to answer them. And Greg and I are also available anytime for one-on-one and direct questions. So again, just appreciate your time, and there's our contact information and our email addresses. Okay, so as many people know, founders of profitable franchisors have many options to consider in terms of how they move forward. Status quo is often a great situation. The businesses got to size and scale, it's profitable, and paying dividends to shareholders is a great scenario. Another one for founders looking for a bigger liquidity event, another option to consider is a debt recapitalization. So you go to the banks, they look at your financial statements and they put kind of 4 to 5 times leverage on your business. You get a dividend, those proceeds from the debt recapitalization become a dividend for the founders. Debt instruments usually have covenants. You have to repay the principal and interest over time, but it is a way to get a small liquidity event. The liquidity event that most people are most aware of for profitable franchisors is doing a private equity transaction where the private equity fund comes in. They typically own up to 80%, sometimes 100% of the business, give the founders of those franchisors a liquidity event, but the quid pro quo to that is ownership. And majority control of a great franchisor business is a very big decision to make, and an outright sale is even a bigger decision to make. So you do get the liquidity, but the trade-off is you're selling equity and perpetual future upside in your business to a third party that will want to have influence on how you run your business. The royalty transaction is the one we'll be talking about today. It's not really well known in the US market. It's something we've been doing in Canada for a long time, and we completed our first transaction in the US market in November. And we think that this will be something that the US franchise market will be very interested in learning about. Getting our first deal in the US market kind of makes it real in that market, and I think there'll be a lot of investment bankers, lawyers, owners of franchisors wanting to understand what it is a royalty transaction is and how it could benefit owners of franchisors over a long period of time. Basically, the introduction is Diversified Royalty Corp. We're a public company in Canada. We've been working with great franchisor businesses for about 25 years. We believe the franchisor business model is a superior business model. And because of that, we think the options available to that type of business model should be superior to just generic outcomes for owners of basic businesses. And that's where the franchise royalty transaction model comes in. Franchisors with proven store level economics, scale, profitability, and the potential to double their store count over time are literally cash flow machines. The operational leverage of a franchisor model at scale is awesome. So if you have a couple hundred stores and you're going to add another 50 stores, you probably got all your G&A in place, the incremental G&A in place to grow that extra 50 stores is marginal, and the incremental profit from getting royalties from those extra 50 stores makes your franchisor substantially more profitable. And that's what makes it a great financial engine. In the early 2000s, Greg and I were working with several of North America's best franchisors. These are businesses that we thought were so good that they should never sell the equity in their business. There had to be a better way to create a liquidity event for the owners of these businesses. And in the late 90s and the early 2000s, I invented a unique royalty transaction that we'll go through today that generates a meaningful liquidity event upfront while selling no equity, providing the owners of these great businesses a far superior alternative to selling their equity. Why a royalty deal? Why a liquidity event? It takes a big effort and often a long period of time to build a franchisor to a point where it's achieved scale and become highly profitable. So it's a slugfest. You need to have a great economic engine. You need to retain great franchisees. You need to manage the system over a long period of time. You have to make investments in the business to get it to size and scale. But when it gets to high size and scale, it's an opportunity to give the owner options to provide or consider liquidity events. So a lot of owners, when they get to the size and scale and become highly profitable, they feel like, it's been such a huge effort, it's time to take some money off the table. And so once a franchisor achieves scale, we believe the equity risk phase while building the scale is over. So maybe when you're from store 0 to store 80, you might raise some equity because that's the risk phase where who knows if you'll get to size and scale. But we think when you get to size and scale, owners of high quality franchisors, that's the last time you should be selling your equity. You should retain 100% of your equity ownership and reap the economic rewards of the hard work and the business you've created and all the growth in new stores and therefore huge incremental new cash flow. DIV's unique royalty structure provides owners of high quality franchisors with the liquidity of a private equity deal while retaining 100% control and the economic upside of continued new store growth. So the all important role, and most importantly, because there is no selling of control, there is no selling of equity, the relationship between the franchisor and the franchisee does not change. The franchisor is still owned by the same owners, the same founders. The same relationship will exist between the franchisor and the franchisee. There is no change of ownership. There is no worries among the franchisee base that something's going to change because there's new people in control of the company. We believe owners of great franchisors and their relationships with their franchisees is a huge success and critical success factor to any brand going forward. And that's another reason why we think the owners of franchisors should keep the equity and keep that relationship with their franchisees intact and unchanged. So when we're looking at the attributes of franchisors for a royalty transaction, we're looking for franchisors that generate stable annuity-like revenue streams. Good store level economics are probably the most important. We want franchisees to get a good return on their time and their capital. That way they can afford to pay their royalties in perpetuity. They are highly incented to sign new leases to extend their agreements, and it makes it a great business model. So a good franchisor has great store level economics for its franchisees. We also look for businesses that are not capped out in terms of store count. We're looking for businesses that have continued new store growth prospects. We're a company of 650 million of size in terms of enterprise value. So we're looking to do deals with franchisors that have at least 4 million of EBITDA. A history of positive same-store sales is, a testament to the quality of the store level economics and the business models position in the market. We're looking for brands that are leaders in their category, long operating histories, and great management teams. We believe that the royalty transaction is primarily targeted at individually owned franchisor businesses that are seeking a liquidity event and don't want to sell their equity. So this gets into quite a bit of details. So again, this is something we're going to go over fairly quickly. It does take some time for the complexity of a royalty transaction to be understood. So working with the owners, their advisors, their accountants, their tax lawyers is all part of the process. So what we're trying to put together here is a very high level overview of how a royalty transaction works to give you a sense of how this deal works. So step one is Diversified Royalty Corp purchases the trademarks from the franchisor for approximately 9 to 10 times the franchisor's current trailing 12 months EBITDA. Again, very high level numbers just to give you a sense of orders of magnitude. Every business is different and the formula is a bit different, but just for these purposes, that's kind of the ballpark. We're going to buy the trademarks for the equivalent of 9 to 10 times TTM EBITDA. Post that, we will license the North American trademarks in exchange for a royalty of approximately the trailing 12 months EBITDA. And we will structure the royalty to fluctuate based on the same store sales growth of the stores that are open today, or at a fixed royalty rate to be determined. The owners of the franchisor company in this scenario realize a meaningful liquidity event. They retain 100% equity ownership in their business, and through the license and trademark agreement, they continue to manage and control the functioning and management of that brand and how they continue to open new stores in the North American market moving forward. So that's the first transaction is kind of creates a big liquidity event for the owners. It's in the form of a capital gain. They can dividend that money out to themselves. So that creates the liquidity event. The licensing of the IP back creates an income stream to Diversified. The owners of the business continue to own 100% of the equity in their business. And where the big upside is for owners of franchisors, in addition to the big liquidity event up front, is they continue to operate and control and run their business. And as they add new stores, those new stores are not subject to the initial royalty agreement. So those stores stay in the possession of the franchisor. And every year or so, as a bucket of new stores are created, the franchise company will be able to monetize the incremental EBITDA generated from those new stores by selling an incremental royalty on those stores to Diversified Royalty Corp. So as the owner of the franchisor, you get a very large liquidity event up front for your existing stores that you've created to date and your existing cash flows. And every year thereafter, under the royalty agreement, if you've been able to create more EBITDA and open new stores and grow your business, there'll be an option for the owner of the franchisor to monetize that incremental growth as well. So since the owners of the franchise own 100% of the equity, they're able to realize the benefit of monetizing profitability from continued new store expansion and the operating leverage of a great franchisor business. So I think, again, at a very high level, I think it's useful to go over a case study, just try to put together in numbers and in a real life scenario. The case study is a company called Boston Pizza. It's the largest pizza casual dining business in Canada by far. The royalty transaction creates a meaningful liquidity event, and the cumulative proceeds from the sale of incremental royalties over time under the royalty model should dwarf the initial liquidity event, and Boston Pizza provides the perfect case study. So 20 years ago, Boston Pizza had 150 locations, 250 million of system sales, and they were making 10 million of EBITDA. The owners of that business were seeking a liquidity event, and I knew the business, and I thought, who would sell that great business? They have 150 locations. They have blue sky to at least 400 to 500 locations over the next 20 years. The cash flow coming out of this business as they grew that business would explode, and the royalty option was by far the optimal solution for Boston Pizza. They were able to monetize their existing $10 million worth of EBITDA in 2002. They completed a royalty transaction and realized approximately $100 million liquidity event. So that gave the owners a liquidity event of kind of almost an outright sale. So they got a great upfront liquidity event. But since they didn't sell any equity in their business, from 2002 to 2022, Boston Pizza opened 270 additional locations, and were able over time under that mechanism of selling incremental royalties as the store base grew and the incremental royalty EBITDA of the business grew. These guys, as they opened those 270 stores, were able to create over $400 million of additional liquidity to the founders. So the owners of Boston Pizzas to date have received total proceeds of over $500 million, and they still own 100% of the equity of their business. They still have the same great relationship with their franchisees, and when they got the benefit of the upfront liquidity event. So it was really the best of all worlds for the owners of that great business. Upfront liquidity event and perpetual liquidity over the last 20 years, totaling 500 million, compared to the 100 million they would have got if they sold all their equity 20 years ago. So the big exciting news, and why we're excited to be doing this, hosting this lunch and learn, is we've been kind of doing this royalty transaction in the Canadian market for the last 20 years. But we completed our first US royalty transaction in November last year with a company called Stratus Building Solutions, with their head office based in LA. So Stratus was a franchise business operating in 65 markets across North America, generating system sales of approximately $150 million. The outlook for Stratus was very strong, with continued double-digit same-store sales growth, and they have the prospects of opening up an additional 85 markets just in North America. The Stratus owners were seeking a liquidity event. They had been approached by lots of private equity funds, but with such strong growth prospects, were reticent to sell a controlling ownership and a controlling equity position in their business. There was just simply too much upside as they executed the growth plan from 65 markets up to 150 markets in North America. They just saw all the operating leverage in their model being available, and something they think they can execute over the next 10 plus years. The Stratus owners were introduced to Diversified Royalty Corp and our unique royalty transaction model at the IFA convention in San Diego in 2022. They came by our booth at the franchise IFA convention in Las Vegas in a couple of weeks. We will have a booth. We hope to all of you guys drop by and meet us in person and get to know a lot more about the royalty transaction that we did with Stratus and how we've been doing royalty transactions for the last 20 plus years. And we're very excited to let the US market know about what it is we're doing with this unique royalty transaction. DIV will also be sponsoring an IFA panel. Basically, it's called Owners Monetization Strategies for Owners of Great Franchisor Businesses. We'll be at the IFA convention March 1st, 9 a.m. at the Mandalay Bay Ballroom A. And the CEO of Stratus will be one of the speakers on that panel. We will also be sponsoring that panel and be there in person to do a quick 2-minute intro and have a booth at the back of the room. And again, trying to get the word out as to what our franchise unique royalty opportunity is, and what we've been doing in Canada, and most importantly, how we've structured our royalty agreement with Stratus. You'll get to meet the owners of Stratus, and I think it'll be a great opportunity to again get more information into the market about what it is we're doing and how it could benefit owners of great franchise businesses. So from Stratus's perspective, the royalty transaction met all of the owners' objectives: meaningful liquidity event, maintain control of their business, meaningful economic participation in the continued growth prospects of their business, so upside, and no change in the relationships with its franchisees. The owners of Stratus believe they can replicate the success of Boston Pizza had with the royalty transaction over the last 20 years. In terms of founder alternatives, like we started this presentation, there's many different scenarios, one of which is status quo. And there's pros and cons to each of them. This is not a comprehensive list, it's just a high level discussion, but status quo, obviously the pro is you retain 100% control. The con of that would be no upfront liquidity event. Maybe the time's not right. Debt recapitalization, retain 100% control is the pro. The con would be it's a modest liquidity event and you have to pay back all the debt proceeds. Private equity / sale, obviously the pro is a significant liquidity event. The con is a loss of control. New investors run the show. They do end up impacting franchisee relationships, even if there's no change. Just franchisees are just not fans of change, and there's obviously the potential to conflict with the founder's goals and objectives. The royalty transaction has a long list of pros that we listed on the prior slide: significant liquidity event, 100% retained ownership, participate in continued growth of the business, and get to manage the timing of a liquidity schedule by choosing when to roll in new stores over time. So just a quick little commercial about Diversified Royalty Corp. We've been doing royalty and trademark transactions in the Canadian market for the past 20 years. We're a $650 million business. We're generating about $60 million of revenue from 7 royalty partners across a variety of businesses. As you can see in the name, it's diversified. We're looking for a diversified portfolio of great franchisor brands that we can partner with founders to create a liquidity event and help them grow their business over time while keeping control. We believe the royalty transaction with Stratus, which was our first in the US market, combined with the royalty model being proven in Canada over the past 20 years with some of the biggest brands in Canada, will be a game changer for US franchisors. Our job today is to let people know who we are, what we do, how the royalty model works. It might not be a transaction that works for you today, but before you're looking for a liquidity event, it's something you should know about, understand, and see if it's right for your business at that point in time. And we're actively looking to partner with owners of great franchisor business in the United States. So just in summary, the owners of great franchisor business in the US have been kind of programmed to think their only source of meaningful liquidity is to sell the equity in their business to either private equity or an outright sale. We believe private equity has made stunningly great investments in franchisors over the last 20 years. The flip side to that is they've earned outsized returns over the past 20 years buying these great businesses. So the people selling the equity, the owners of these great businesses, have been selling a ton of upside, and the private equity funds and the buyers of these businesses have reaped outsized returns, and that creates an opportunity for owners of those businesses to keep that upside for themselves. They are, in fact, the people that have created these great brands, created these great business models, and they're the ones that should be able to kind of almost have their cake and eat it too, create a big liquidity event for the business they've created, but also keep the ownership and the upside. So we believe franchisor business model is a superior business model, and owners of great franchisors should not have to sell their equity. If they want a liquidity event today, they should be able to continue to run their business with 100% ownership control. Our unique royalty transaction provide owners of great franchisors with the liquidity of a PE deal without selling any equity. It is a game changer. And so I appreciate you guys taking the time to listen to and learn more about Diversified and what we're doing and how a royalty model works. Like I said, it's a fairly complex transaction. We've tried to summarize it here. Greg and I are available for any follow-up calls. We'll answer whatever questions you have today. And I look forward to working with you and answering any of your questions. So it looks like the first question is from Robert. Why do they want to own the brand and the IP? How do they make money? So that's a great question. So as with any transaction, there's a quid pro quo. The structure of the royalty transaction is we're buying the brand and the IP. So we're buying an asset that creates some tax attributes for us that help us reduce our taxes payable going forward. We do license the brand and the IP back to the franchisees in the North American market so that they could use those trademarks to continue running their business. For every transaction, there has to be some sort of give and take. We're obviously providing a huge liquidity event, and in exchange for that, we're buying the brands that we're in effect licensing back. That's how our transaction works from a tax perspective and accounting perspective. How do we make our money? As we're buying the trademarks and licensing them back for a royalty on, let's say, your 200 existing stores, we're getting a royalty stream on those 200 stores from the franchisor to us in a cash flow stream. So we're paying for a future cash flow stream, which is usually structured as a royalty on your existing stores only, not on new stores. The new stores that come into the business are the assets of the founders and the owners of the equity. We're buying a royalty agreement on the existing stores today. Can we get a copy of the slides? If you go to our website, diversifiedroyaltycorp.com, and go to the Franchisor tab, you will see this exact presentation that we gave before Christmas. And you can see the slides and hear that presentation that we gave before Christmas as well. So another question from Lonnie, how much royalty does the franchisor sell? All of it. That's really a negotiation between the franchisor and Diversified, depending on the growth prospects of the business, how many new stores it's opening up. The franchisor can sell up to all of its existing EBITDA. If the owners of the business want to keep, they're not comfortable with that, or they'd like to sell less, we're happy to buy less. Actually, we'd rather buy a royalty stream equal to 80% of your EBITDA, because then there'd be some royalty coverage to give us cushion on the royalty stream we're purchasing from the franchisor. So it's a negotiation. Most importantly, it's what's comfortable for the franchisor, because at the end of the day, this is a transaction for the franchisor to do what makes sense for their business. And if it's a smaller royalty stream that, like I said, is actually better for us, if we get comfortable with the business and its growth prospects, we can give the owner more liquidity by buying more of their EBITDA. But it really comes down to the quality of the existing cash flow streams of the business, as well as the future prospects for new store growth. So I think that covers the questions that are in the chat box. Like I said, Greg and I are available to discuss any follow-up questions with anybody at any time. We're in the business of educating the market as to what we are and what we do and how the royalty transaction works and has worked in the past. And I just, again, appreciate your time listening to what we're doing here at Diversified, and hopefully getting a chance to meet you at either our presentation on March 1st or at our booth at the IFA convention in Vegas.
Great. Thank you so much, Sean and Greg. This was excellent content and excellent feedback from all of you. We really do appreciate it. Again, this webinar was recorded and along with the presentation deck will appear on our website early this evening. You'll be able to find that at community.franchise.org. Thank you very much again to Sean, Greg, and the Diversified Royalty Corp team. And again, thank you to everyone for tuning in. We hope to see you all next week in Vegas. Have a great rest of your day and stay safe and healthy. Bye.
Thanks, guys.